is India's future outlook for the next 5 to 10 years? What is in store for you as an investor? How will the nation evolve in terms of economic growth? Financial expert Mr. Annoy Kumar will guide us through. Annoy Kumar, the screen is yours.
We are the third largest economy, on a GDP, and we are behind US, China, Germany, and Japan. And we are at a fifth number if we talk about. But aspirationally, if you would see it, we are talking about being the third largest over next 10 odd years. So the whole movement of being the fifth largest to third largest, being at 3 point or shade below $4 trillion economy to almost shade below $9 trillion economy, I think that is a huge opportunity for capitalizing when it comes to the wealth creation by you all. And I think that is something that you all should keep in mind when we talk about the opportunities. Now, when we look at GDP contribution going up from a 3.7 to 8.7, what it is further letting us do is that we are actually becoming the fifth largest country on a market cap. And we are just shade below Hong Kong and Japan. And now we could be an economy maybe over a couple of years just behind US and China. Exactly the way in terms of being the size, we are just behind US and China if we are in 2033. Now, this is the size of opportunity that you all can think of being a part of it. Now, if I go a little further, now this is a very important slide which will help you understand why we are so excited about India. Now, what are we doing it? What are we doing it is we are simply, telling you all that India, if I look at as an economy, has a GDP of close to $3 trillion. Now, $3 trillion, if I look at coming from the credit system, which is the credit part of that economy, it is pretty much 65 on the corporate, 35 on the retail. Basically, around 1.4 trillion INR, the credit that people have taken, 35% of the credit actually is on the retail book, which is the people like you and me on the retail side are consuming. And if I translate that retail exposure, actually I do see India in three parts: India 1, India 2, and India 3. And the way to look at 3 India is basically bucketing them on a per capita income. The ultra rich of India is called India 1. The mass affluence of India is India 2. And the India 3 is basically the deep retail, the people who are just moving into where the per capita income is less than 1,750 US dollars. You know what is very surprising? The very surprising is when India 1 is just 10% of the total households that we have, just 10%. So we have $1.4 billion population, 329 million households. Out of 329 million households, only 33 million are in India 1. Only 10% of the Indian consumers are representing India 1. And these are the people who are drawing salary more than $3,700 per annum. And their exposure, the consumption, they are actually consuming 70%. So 10% of population is consuming 70% of the exposure. This is the way we are skewed. If you today look at the passports, we have close to 32 million passports, all in India 1. Credit card, 34 million credit cards, all in India 1. Cars, 55 million cars, largely in India 1. So India 1 is the space which is actually consuming the maximum today if we look at India. If you go a little ahead, India 2, which is 20% of the population, they are only consuming 20% of the credit exposure. So 20% population having a per capita income between 1,750 to 3,700 are actually consuming 20% of the credit exposure. So basically, if I look at 30% of the household, 30% of the household is actually consuming 90%. Now, where is the opportunity? The opportunity is in India 3, which is 70%. This is only consuming 10. And by virtue of the Jan Dhan Yojana and all of the things which is to get many of these people into the system. Now, this India 3 is now ready to be a very large consumer. All the subsidy payments that were getting done till today, all the subsidy payments were happening in cash. Now those are not happening in cash. They are coming into your account. Basically, large part of the money is coming into the system. If the money is in the system, they will consumed also in a proper way. This is a huge opportunity which all of us are seeing in the financial sector. Why? Because India 3 is going to become a major contributor to our consumption cycle. Now look at any of the banks. If you, I'm sure many of you would be banking with ICICI Bank, with HDFC Bank, with Axis, with IndusInd. What are the CEOs of these banks doing? All the CEOs of these banks are saying, look, I'm happy not to offer, mutual funds. I'm happy not to offer insurance, but I need more branches. I need more branches in the rural area. I need more presence in the hinterland. Why? Because they all are seeing a massive opportunity unfolding through India 3. And nobody wants to miss on that opportunity. They all would want to capitalize on that. And which is one of the reasons that we all feel so happy that consumption cycle will trigger massively when India 3 will start contributing. So that's an opportunity which all of you should be mindful of in terms of unfolding as we go forward. And this has been the reason that we say that, we are all set to become the third largest on the GDP and the fifth largest on the market cap. The reason for doing all of this is because a large part of the population is now getting into the system, and they are the set of people by virtue of consumption will become a massive contributor to India's economy. Now let's understand what is happening to corporate balance sheets. Now this is another beautiful slide which just tells you that at the end of the day, what is very important is that the balance sheets of the corporates needs to be healthy. And why do I say the balance sheets needs to be healthy? Is only because with a healthy balance sheet, your ability to go for a capex becomes even more stronger. Now look what has happened. If you see the corporate debt in the balance sheets have started coming down, that only would mean the corporates have been retiring their debts. They are repaying their debts. Their balance sheets are becoming healthier, less of debt on their books. If you see the left-right chart, it gives you another picture. And this is a very interesting picture because if I combine 1 and a 2, that will help you understand why am I so happy and so excited about India. The right-hand side tells me that if I see the capacity utilization, for example, if you have an ability to produce 100 units, you are actually already producing 75. Your capacity utilization is 74.6. So if you can produce 100 units, you're already producing 75. That means 75 is already getting consumed. That means demand is robust. And whatever you are producing is getting consumed. Now that is a very important point because that puts pressure on the promoters to go for a capex. Because the thumb rule says, as you get closer to 80 as a number on a capacity utilization, you are not left with any option but to go for a capex. Because capex itself takes 3 to 5 years. So if you go for a trigger on a capex today, maybe after 5 years, you have a capacity added. And by that time, you are already 100% consuming of the existing capacity. And you need to produce more, and which is the reason you have to go for a capex today. Now, if you see this, add the two things, 1 and a 2 now. I have a need for money. Why? Because I need to go for a capex. And the only way I can get more money if my balance sheets are stronger. So less of a debt on a balance sheet and a need for a capex The two of them are a perfect combination for one to go for a massive capex expansion. Please understand, once these capacities would come into foray on a production, all of them only would mean more employment creation. Why? Because when you add capacity, you would need more people to work in terms of helping you produce those number of units. When you add more people on employment, those people eventually will become consumers. And that is going to kick in your consumption cycle. Today, world is struggling. The world is struggling with recession. Why? Because they do not have enough demand. Our problem is very different. If you want to have a dream car of yours, you have a waiting period of 6 to 9 months. Globally, we are struggling with recession or a stagflation. India has got inflation. Inflation only comes when you have demand. That means your demand supply equation in India is very, very strong. Now, this is something which again is the reason why we say India has the potential to be the fifth largest country on a GDP, and from a fifth to third largest it can go to, and it can move ahead when we talk about the market cap further, and it can potentially be next to two giants which are US and China, and pretty much be ahead of all the economies that we can talk about. If I further see the corporate profit to GDP at the end of the day, if you want to go for a capex, if you want to have a strong balance sheet, one thing which is very, very critical is that your corporate profit to GDP should be moving up. Only when the corporates are producing more profit is the time they can go for a better expansion plan. Look at it, what was happening. From 03 to 07, we were like moving up. And remember this, because I'm going to use this data somewhere else also. But just remember, between 2003 to 2007, we were just moving one way. And then we realized that this is not sustainable, and we started falling. And if I go back last 20 odd years, our average corporate profit to GDP is 3.7. From 2020, just after COVID, if you see, we have again started moving upwards. And we are way above our average. Now, this is something that you should be mindful of, that as much as the balance sheets are clean, as much as there is a need for a capex, even if I look at a corporate profits contribution to GDP, this is also moving upwards. So this only tells me the balance sheets are very, very strong and very, very promising. If I move further, now monsoon for us and for everybody had always been a joker in the pack. Last year, the monsoon wasn't great. Year before, the monsoon wasn't great. 2019-20, we had a good monsoon, but 21-22 was an average to neutral. What it does is, see, at the end of the day, we are agrarian economy. An agrarian economy would only mean that a largest part of the consumption cycle gets established with the rural market. If the rural market are producing and are promising, you would start noticing that the consumption cycle starts getting established and the GDP of the country starts going up. This year, if I look at, there is a decent forecast of almost 63%, where we are talking about monsoon to be between 96 to 110. 63% forecast says that monsoon would be above 96 and maybe closer to 110. 30% further says we will be in excess of 110. So if I take away 10% which talks about deficient to or below normal, 90% of the view today is that the monsoon would be normal, above normal, or excess. That only tells us that this year the probability of seeing a very good monsoon is extremely high. Now, what it is leading to? A better monsoon only would mean that we are once again re-establishing our consumption cycles through the rural market. And with that coming in the foray, you will start noticing that uh, you know uh, the economy starts getting better. Now, India is a very unique market. It's a very unique market. Why? Because this is a market which we call a compounding machine. All the markets that you would have seen are struggling today. India is still talking about growing at almost 8% GDP. Now, what do I mean by compounding? If you go back and look at India on a 20 years, over a period of 20 years, to produce 20 percent GDP, growth or a CAGR, you will be surprised to see that in India has almost 98 companies, which has given you a wealth creation opportunity of 20% over 20 years. So 98% companies have given a return of more than 20% over 20 years. And if I compare in the same bucket, which is a BSE 500, with a list of 500 companies between us, US, China, and Japan, you will be surprised to know while India can talk about 98 companies producing 20% over 20 years, US only has a count of 18, China 10, and Japan no. Not a single company has given a return of 20 over 20 years. Now, okay, one of you may feel 20 is a little harsh. Can we look at 10 years only? Let's not look at 20 years. So if you see that chart on the right, it talks about 10-year compounding on a 20% CAGR and a 25% CAGR. 23% of the corporates in India, 23% of the corporates in India, over 10 years have delivered 20% CAGR. And 14% of the corporates in India have delivered 25% CAGR over 10 years. The number of in US and a China, Japan doesn't have any, as you have seen, zero. The number in US and a China is in lower double digit or a single digit. India is talking about a healthy double digit. Now, this is the compounding machine that India has eventually got itself into, and which is the reason so much of wealth creation can potentially happen in India.
Thanks for your detailed answer. If you have any doubts regarding this or any other financial decision, don't hesitate to book an appointment with our financial experts. The link to the appointment is given in the description below. And also, would you like to know more about finance and investment? Then we would recommend you to attend our live webinar. The link to the webinar is also given in the description below. The webinar is absolutely free. If you like this video, hit like. If you are new to our channel, please do subscribe. Thanks for watching.